You ever hear this song from the 80s? I think it was the Bengals. We got Wolf Street, we've got Wolf Street, we've got Wolf Street. Yeah, we got it. What's this? Today's mortgage rate 3.06 on a 15-year. Oh, on a 15-year. That was a little lending tree advertisement. Single family home, primary home. We'll do Brandon, Florida. Just want to check this out real quick. Yes, I have already found my new home. Are you currently with? Yes, I'm working with an agent. 250, yeah, okay. How much are you putting down? 11 to 15%, we'll say. I just want a freaking mortgage rate. Lending tree, you're killing me. Jeez, I want to fill out everything. Just give me the damn rate. So, now remember I said 4.2. Hey. Today's mortgage rate, interest rates for purchase. A 30-year VA rate, which, again, it's the APR. Interest rate APR. It's the APR. APR is slightly higher. 3.41. Now, I just said it was 4.2 something, remember? 3.4. 30-year FHA rate, 3.3. And then we have the 30-year fixed jumbo for 4.14. And then a 15-year jumbo. There'll be a freaking jumbo. Anyways, I was just curious because, like, man, the rates have dropped a little bit, haven't they? Isn't that interesting? Wolfstreet.com. What's behind the subprime consumer loan implosion? Now, Gran, you turn on the news. Oh, what implosion? Thought everything was fine. Thought we had the greatest numbers ever and everything else. No? These are the good times. But why are subprime credit cards, auto loans, and short-term installment loans blowing out? Now, granted, Joe, what is a subprime? What does that mean? Well, I'm glad you asked. It means, well, if you have a terrible credit score, not bad, but terrible, below terrible is subprime. Because even terrible today, anyone's approved sitting behind the wheel before 10 a.m. Be sitting behind the wheel before 10 a.m. Not Sunday. Terrible, and then they're subprime. Okay? The subprime borrower has credit that is worse than terrible. And I used to say this. It's been a long time. And I said this is going back to the 08 and 9 thing when that was happening. So my YouTube channel would have been quite new. But I remember saying, even years later, like, because you got to remember the housing really hit the bottom around 2011, 2012. That's when you could get like some really good deals. Even though the crash or whatever was 2008, 2009, it still took a few years to catch up. 2011, 12 was the low for the housing. But I said, with all these people who just had their entire credit and everything destroyed, our system is dependent on people being in debt. And you can't be in debt if you're not approved. So how does this system work when a whole bunch of people are not creditworthy? I said this. They'll have to lower the ratings of acceptable borrowers. They'll have to lower the score. Yeah, we'll accept those guys. And that's exactly what's been going on and has continued. We have a huge number of people in the subprime category. These days, 2019, almost 2020, yes. So, these are the good times. But why are subprime credit cards, auto loans, and short-term installment loans blowing out? Okay, we've got a situation in subprime consumer loans. The delinquency rate on credit card loan balances at the nearly 5,000 smaller commercial banks in the United States. This means all banks, except the largest 100, is blowing out, according to Federal Reserve data. In the third quarter, the delinquency rate at these banks rose to 6.25%. That's higher even during the peak. Hold on. Like, I got to get ready to tell you this. Because as you know, I don't read these in advance. I'll read a little bit sometimes, a paragraph. Oh, yeah, I want to talk about that. Send it to myself an email. So sometimes I'll read it, and it's like kind of shocking to me as I'm reading it. Like, I gotta get my composure straight before I tell it to you guys. And I just corner my eyes. I'm reading aloud. Ooh. So I'm going to compose myself and try that again. The delinquency rate on credit card loan balances at the nearly 5,000 smaller commercial banks in the United States, this means all banks except the largest 100, is blowing out, according to Federal Reserve data. In the third quarter, the delinquency rate at these banks rose to 6.25%. That is higher even than during the peak of the financial crisis, 2008 and 9. It's higher now than then, but I thought the unemployment was the lowest it's ever been. Everyone's got a job, manufacturers coming. Something's not right. And this is precisely the reason I could not sell my silver. Could not just, the hell with cryptos. Oh no, I'm hanging on to my cryptos. Because when this stuff starts letting go, again, starts hitting us again in our face, when they can't fake it, paper it over, again, if we go negative interest rates, if Donald Trump pulls that trigger, and that could honestly be the only game left in town to keep this, shot through 1,000-time boat hull system, bandages everywhere. It's the last thing that would at least feel like a recovery and act like a recovery for this little guy. Everybody's in debt. Everyone has payments on something. Again, typically it's your house. And that's the biggest one. So if you can fix one of those, boy, that would be the greatest, right? Negative interest rates, super low mortgage rates. You're going to put a lot of money in people's pocket. And as I said in my last video, Donald Trump, his whole family will be elected for like 100 years. And he's been telling you, I want negative interest rates. I want a cheap dollar. He's telling you this. And I'm waiting. Hurry up. I'm ready to refinance. I'll do it just because if it's low enough, come on, give it to me. Give it to me, baby. All the girlies say I'm pretty fly for a right guy. That was The Offspring. Thank you. Back in 2016, the credit card delinquency rate at these banks was in the 3% range. It has more than doubled in 2 years. Credit card balances are considered delinquent when they're 30 days or more past due. This delinquency rate means that out of the bank's total credit card balances, 6.25% are 30 days or more past due. This is a disturbingly large rate. But delinquencies are a flow. Balances are removed from the delinquency basket, either when the customer cures the delinquency, such as catching up with past due payments, or when the bank charges off the delinquent balance against its loan loss reserves. But as these delinquent balances were taken out of the delinquency basket, even more delinquencies, new ones, fell into the basket, and the delinquency rate rose. Subprime auto loans have also been blowing out. In the third quarter, the serious delinquency rate of the $1.3 trillion in auto loans has now risen to 4.71%. Excuse me. Quick look surprise, get ready. The highest since the worst months of the financial crisis when the auto industry collapsed and when the U.S. was facing the worst unemployment crisis since the Great Depression. And I'll add another one. Cash for keys, man. Cash for clunkers. Turn in your old clunker, even if it's a good running vehicle, and go buy a new one. We'll give you a great rebate. Obama, look what I did to help. You got rid of a whole bunch of older cars that were working fine so that you'd force these people to go spend money they didn't have again. And here's the tail end of that. We're not at whatever the rate was before. Now we're at 4.71%. In the third quarter, about 21% of all subprime auto loans. So in the third quarter, 1/5, 21%, 1/5 of all subprime auto loans were seriously delinquent, meaning 90 days past due or more. When we got another glimpse of this upheaval in subprime with some of the specialized lenders that cater to them, not when, then, So then we got another glimpse of this upheaval in subprime with some of the specialized lenders that cater to them. For example, World Acceptance Corporation, which does small short-term consumer installment loans and some larger medium-term loans to people who need money desperately and have subprime credit ratings. Like most specialized subprime lenders, World Acceptance charges blistering interest rates, but then it also has large default rates too. It reported disappointing results, now 2 quarters in a row, by the way, and its shares have plunged 45% over the past 4 months. So what's going on here? Back in 2009, people were defaulting on their auto loans and credit cards and their installment loans because over 10 million people had lost their jobs. This is not the case today. Back then, new unemployment claims, a sign of layoffs, spiked to astronomical levels. These days, they've been hovering near historic lows. So today, these people are working and they're falling behind on their debt service. That is the key. They're working, they have jobs, and they still can't make the payments. Subprime doesn't mean poor or uneducated, by the way. Subprime means having a credit score below 620. And again, you could be quite below that and you can still find a way to get a loan. For example, a family of 2 working adults and 2 kids, the household income is $200,000. They bought a house and stretch to make the mortgage payments. They bought nice cars and have to make those payments. Their kids cost all kinds of money, of course, and it adds up. And they're spending every dime they make. Then one of the earners gets seriously sick and can't work for a few months. And the deductible on their health insurance is, well, $4,500 a month. Or not a month, but $4,500. And soon their 6 credit cards are maxed out. So they go through daily triage about what to pay. Mortgage payments, auto loan payments, minimum payments on their maxed out credit cards, groceries, clothes for the kids, bills, gas, and so on. And they fall behind. And late fees are racking up. And their credit score drops below that 620 number. And now they're subprime. They can still borrow, and they can still get more credit cards, but now under the terms of being subprime. So banks take risks on credit cards because credit cards are immensely profitable. Until they're not. Credit cards, unlike auto loans or mortgages, are unsecured loans, meaning you default on the car, they come repossess the car and resell it. On your credit card, there's nothing there. Kind of like our dollar is backed by nothing. Well, so is this credit card loan. Basically, this credit card I've got is backed by nothing. If I default, sorry about your luck. And recovery when the loan goes sour is small. The bank may sell the delinquent credit card account to a debt collector for, well, cents on the dollar, and that's all they may ever get. The hope is that income from interest and fees from other subprime credit cards that are still current in making their payments will step in and deal with the losses that the company has taken. So the credit card, you can have a car loan for 15% because you're subprime. Because 1 or 2 other people who are subprime and 15%, they ain't going to be able to make their payment. They're going to default. We're going to lose a little bit. Have to resell the car for less, all that stuff. So we're going to lose a little bit. But since you're paying 15%, some of the rest of y'all are, you guys are going to help make up for this. That's what they're saying here. The whole thing is structured that way. So the banks take big credit card risks for big profits. And when the losses pile up, at least at first, they're just part of the cost of doing business. The calculus works out in good times and snaps back in bad times. We can use the nearly 5,000 smaller banks with their credit card delinquency rate of 6.25% as a stand-in measure for the subprime. And here's why. The largest 100 banks have a delinquency rate of just 2.56%, which remains low by historical standards, and is just a small fraction of the peak delinquency rate during the financial crisis. They can offer the most sophisticated incentives and marketing to attract the prime-rated customers. Overall, they have most of the customers and most of the credit card balances, and they get the lion's share of prime customers. They also go after subprime. But since they have the lion's share of prime customers, the portion of subprime customers don't weigh heavily in the mix. But smaller banks cannot offer the same kinds of incentives and marketing and often miss out on prime customers. So proportionately, they end up taking more subprime customers, including those that were turned down by the largest banks. And in this way, they become a measure of subprime credit card delinquencies. But why are credit card loans and auto loans and other risky consumer loans now running into this kind of turmoil when they hadn't in 2016, for example? There is no employment crisis. We haven't seen millions of people getting laid off. But there is something else going on here. I can see two factors. One factor in the subprime turmoil is greed. People with a subprime credit score know their credit score. They know they're having trouble borrowing. They've been turned down. They can't buy a car and finance it at the ultra low interest rates they see on ads because they don't qualify. Same with credit cards. They tried to get the 2% cashback credit card with no annual fees and 7.9 APR, but got turned down. They're now conditioned to take whatever they can get. In other words, for the industry, they've become sitting ducks. Lenders offer them credit cards with the highest interest rates and the biggest fees. Auto dealers make big fat profits off these folks, and specialized subprime lenders charge them dizzying interest rates to finance these cars. That's all they can get. No one forces these people to take out these loans and credit cards, but they're trying to maintain their lifestyle, however basic it may already be, and they're trying to feed their kids and drive them to school, and so they borrow at these high rates to make it work. But the high interest rates increase the probability of default because these people who are already strung out will have even greater trouble making the payments. That part is driven by the industry's greed. Aggressive subprime lending went into overdrive starting in 2014, and private equity firms piled into it, and smaller banks went after it, and it's now coming home to roost. The other factor in the subprime turmoil may be something else, something that would impact people the most who are already strung out, people who have jobs but they're living from paycheck to paycheck, and not necessarily because they're splurging, but because at their level of the economy, prices of goods and services they need have risen sharply and outpaced their incomes. And this can happen overnight. Did you just see my video previous to this one, or maybe the one before that, about the Federal Reserve? We're thinking of adding a new rule to make up for lost inflation, and we tried to target 2%. It wasn't good enough, so we're going to make up for that, and higher inflation. That is precisely what would be devastating and what he just said, and this can happen overnight. This includes healthcare costs, and it includes food costs and apartment rentals. Again, and the Federal Reserve's policy. I'll add that one. And cars have gotten a lot more expensive and the like. But cars and apartments and cell phones have gotten a lot better too. And these quality improvements are added to the price. Think of the move over the years from a 4-speed automatic transmission to an 8-speed automatic, or from 2 airbags to now 10 airbags, or from a basic cell phone to a smartphone. But for figuring the inflation measure of the Consumer Price Index, the cost of these quality improvements are removed from the index. This is the principle of hedonic quality adjustments. Inflation measures the loss of purchasing power of the dollar, what the same things cost over time. But when quality improves, such as in a car, it's no longer the same thing, and the costs of those quality improvements are removed from the inflation index. So the CPI for new cars has been essentially flat since 1995, meaning no inflation for 20 plus years, when in reality the actual prices have jumped. For example, the price of a new Toyota Camry jumped by 25% between the years of 1995 and 2019. With used cars, it's even worse. The CPI for used cars has declined by 11% since 1995, but actual used car prices have soared since then. This goes for many other products and services across the spectrum. And then consumers, even when their income rises faster than inflation as measured by CPI, run into this problem where their income no longer suffices to buy these goods and services, including used cars and healthcare or housing, because actual prices of these goods and services have far outpaced both inflation as measured by CPI and wage increases. This goes increment by increment. What might have worked last year suddenly doesn't work anymore this year. These consumers with jobs that have been living from paycheck to paycheck suddenly find themselves confronted with a 20% increase in health insurance premium or a 10% increase in rent, or maybe even both of those. And suddenly, as Saul Rosenberg once said, suddenly, all of the sudden, my shadow tried to choke me. And suddenly their whole fragile equation doesn't compute anymore from one day to the next, and they fall behind. As more consumers are getting caught up in it, subprime starts to blow out, even in what are considered the good times, because actual prices have outrun these people's incomes, and they're confronted with it, such as with rent or healthcare, etc., from one day to the next. That was Wolf Street by the man himself, Wolf Richter, at wolfstreet.com. Again, these are the good times, but why are subprime credit cards, auto loans, and short-term installment loans blowing out? These are the good times. And again, house mortgage, 4%, 4.6, 3 point something. I just did the video a minute ago. These are the good times. How are so many people not able to pay these bills? Again, the only thing, in my opinion, that can fix this, negative interest rates. And we don't need to buy crap from China anymore. Get rid of it. Sorry. We don't need trade deals, nothing. We have everything we need in our own country. We could bring back manufacturing massively. All the trash and garbage we get from China, we could make it here in America. And honestly, with our standards, let's not make it so it's crap and breaks as fast as something from China would. You know, you replace something from China 3 times. Well, I'd like to just buy it once. American made, call it a day, hand it down to my kids when I'm done. Like, I won't have to go buy 3 or 4 of these things in, 2 years. Well, yeah, but man, it's only $10, man. If I bought that American, it would cost me $25. Okay, well, have fun buying 4 of them, and I got $40. I'd rather just pay the $25 once and call it a day. You know what I'm saying? So, yeah, Donald Trump's got his hands full. It's not his fault, just like no matter whatever president will be next, it won't be their fault. But this is decades and decades of the criminal elite taking advantage of our country, of our citizens, our tax dollars, giving it to their friends, massively overcharging us for everything, giving them government contracts of epic proportions, free money for Ukraine, free money for Israel, free money for everybody. Billions. Here you guys go every year. But we got Americans here who can't pay their rent, can't pay their mortgages, can't pay car payments, getting stuck in debt. And you know what I say? If you're a candidate for bankruptcy, pile it on. Pile it on. And then file. You have a right to do so. Take care.